Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Life Liberated podcast. Now, on to the show.
Hello and welcome to Life Liberated with the team from Centura Wealth Advisory. Joining me now is your host, Derek Myron. Derek, how are you? And what is today's topic?
RJ, thank you for that nice introduction. Good to see you, my friend.
Good to see you.
Today's topic is I've got a special guest in the audience today, my friend Jonny Borok. Jonny, welcome to the show.
Thank you. Good to be here.
My friend Jonny Borok is a fractional CFO, and together we work helping clients achieve their investment estate planning goals. And I thought it'd be a great conversation to understand how do fractional CFOs help business owners, what kind of business owners should consider fractional CFOs, and what are the kinds of things that wealth managers, tax strategists, and CFOs work together on helping clients meeting their investment estate planning goals. So without further ado, I'm going to jump right into it. But before we get started, who is right to listen to this? The listening audience today should be ultra high net worth business owners, folks that we typically say are 20 million and higher, and the professional community who serves those individuals. So we think those are the right audiences to listen to this podcast. And so without further ado, let me throw it over to Jonny. Jonny, tell us about you and your background, your educational background, family background, and your business.
So I was born and raised in South Africa.
I couldn't tell that. I could not.
I know my Texan accent is sort of the giveaway. Was educated at the University of Cape Town and worked for a then big 8 firm, Arthur Andersen. I was fortunate to get a transfer from Cape Town to Los Angeles and continued working with Arthur Andersen, and then went out into the business world, became a full-time CFO and then a fractional CFO. My family, brother, sister, parents, all born in South Africa, all immigrated to the US. My former wife is also from South Africa. My kids were born in California, and most of my immediate family now still resides in California.
Nice. You got them all to move across the world.
Everybody came to the West Coast.
Yeah, nice. Well, I know you were a CFO for a very large family for a very long time, and you enjoyed that work you've shared with me. But what's the difference in the work between working for one family, one set of problems, and then working as a fractional CFO, seeing many different businesses and many different sets of problems?
So as a full-time CFO, my sense is one would get involved. I got involved in a lot of day-to-day issues, a lot of detailed work. I would say almost 70, 80% was very detailed work, more routine, more of a maintenance mode. I find as a fractional CFO that I get involved much more at a high level. A lot of the detailed work can be delegated to others. And it therefore, from my perspective, I certainly enjoy being and working with at a higher level and also dealing with more complex issues, more of the high level issues, more of the fun stuff, as opposed to more of the routine maintenance stuff. And I think that's a very big difference between being a full-time CFO and the fractional CFO.
Would you say, if you're dealing with the higher end issues, it probably keeps your skill set sharper, seeing a diverse set of problems and seeing at the high level stuff probably helps you professionally develop as well, correct?
I think so, very much so. I would say where in a full-time role, and even if through your career, you've had multiple CFO roles, you see certain issues, you only see them once a year. As a fractional CFO, you might see those 5, 6, 10 times a year. And I think it definitely makes you more knowledgeable, more skilled in those particular areas. I also find that there's definitely a cross-pollination between clients. And sometimes you come across an issue with one client that's applicable to 6 and is very, very valuable to them. So the issue might have been an hour or so or 2 hours of work, of research, of collaboration. The other 6 clients effectively get that value and benefit with 5 minutes or 10 minutes of input. So there can be very, very high value that's provided to the other clients that are the that are the beneficiaries of the cross-pollination.
And I've seen that firsthand, especially, I'll just comment. Jonny and I have worked on a particular client together, and going through COVID and all the different programs, whether it be PPP or I won't name all the acronyms, but being able to say, oh, Derek, two other clients that I did it this way, and oh, for this program, we should worry about this. And whether it be, I mean, there's a whole bunch of different acronyms, but I've seen that firsthand and very, very valuable.
Right. I agree.
Yeah,
I agree.
So we met a common client that this gentleman brought us in and then interviewed and brought you in. And so we've been working to help this client. And, like lots of clients, lots of entrepreneurs, they have lots of ideas and are going in a lot of different directions. And this guy's no different. Is got a lot going on and taking on the world in a variety of ways. And we're fortunate enough to serve him in these two capacities. What particularly do you really enjoy about serving that relationship? What's enjoyable about that?
So that particular client is very entrepreneurial and really has got involved and is looking to get involved in a whole variety of different areas of business. And again, for me, when somebody has that focus to look at new things, to look at different things, to look at challenging opportunities, that's far more attractive to me than doing the routine maintenance kinds of things that I was referring to that a full-time CFO would do. And so it just makes it much more interesting. It's much more challenging. It's often difficult to shift gears between different clients and to shift even within a client when they're thinking about lots of different things and moving in different directions. But it is far more interesting, far more enjoyable to be working with somebody that's true entrepreneur at heart.
Yeah, I think it's also super helpful. This gentleman really values advice and does a great job he's got a great accounting team to bring us the numbers that you kind of oversee to make sure, hey, we have accurate numbers to base good decisions upon. We also have good legal counsel, both general counsel and estate planning counsel. And then he's done a good job of following recommendations on good tax compliance counsel. And although those three groups aren't as intimately monthly on the day-to-day as we are, I think the combination of those four groups, from the accounting people to the estate planning folks, to general counsel, to the tax counsel, has made our jobs far, far easier.
I agree. I think that the client in particular being receptive to having experienced, knowledgeable, skilled professionals working with him, I think is huge positive. I think it's the right way to go. I think there are a lot of entrepreneurs or owners who don't necessarily follow that course, and I think they're shortchanging themselves. I think that particular owner has now recognized that the value of having a strong accounting department in order to produce numbers that you can rely on reasonably timely basis to be able to base all of the wealth strategies and tax planning work on is very important. I mean, that is one of the cornerstones, I think, of my practice, is making sure that each client does have a strong accounting department and that they do produce a very good financial package every month and produce that on a timely basis.
100%. So when we think about helping entrepreneurs like this, this gentleman is starting new businesses, not planning on selling businesses right now, but he's bringing in millions of dollars of income and it's not predictable the same, like, oh, just pull out last year. It's nothing like that. Having the monthly data such that we can really see what's happening, what's trending. From our perspective, we are wanting a client to be able to set up 4 or 5 levers throughout the year to mitigate taxes for that year or the prior year. And it's very data dependent. So it's so data from the information that the accounting staff provides you and you bless, and then it gets to us. So we can then say, okay, here are the 3 or 4 or 5 decisions that should be made this quarter. We find it to be the appropriate way to dispense income tax planning advice over a 3, 4, 5 year period. What's been your experience?
Mine is no question very similar and I would say almost the same. And a couple of points that I would make. One, which is the ability to review the financials and assess the trends and then update. I generally don't recommend changing an original budget once it's cast in stone or cast in stone. Leave it as is, and then reforecast or reforecast. Either one works, but do that periodically. And so when you see a trend in a particular month's numbers, you can immediately say to the accounting team, okay, let's go through this exercise. Let's update it so that we have good information to share with the owner, so he knows where the year is likely to land up. And then B, we can now adjust from a tax planning perspective. And I think that is one of the key points of differentiation, if I may share, in terms of Centura's approach. I think the whole tax planning aspect is quite unique and works really well with the CFO function. It results in a much better outcome for the owner. So by having that and being able to update, as we're even doing this month, and being able to meet on a regular basis, have a look at that income projection, and then look at the various tax levers that you're bringing forward, I think is a highly valuable process for the owner of the company.
Yeah, I think, in talking to owners, I think not very many people really understand, like, what really is the approach. And we have these low brackets going up to, once we're over 650, 700,000, if you're married, you're in the top bracket in federal. And then once you get over $1.5 million, you're in the very top bracket, 13.3%. Or if it's W-2, you're at 14.6% because of new Senate bills that went into effect as January 1st. But if you can take that, if you've got $2, $5, $10 million of income and get it down to the 600 grand, where you're going through those, we don't want to get it down to zero. We want to get it down to 5, 6, 700 grand, where we've run through those low brackets are opportunities.
Right.
Trying to get everything down to zero is not our approach. We want this income averaging of, how do we get income off, not to hit the tax return? So that's step one. But if it hits the tax return, what are the exclusions, exemptions, deductions, and credits we can apply to get your 5 million, your 2 million, your 10 million down to 600 grand? And what are the levers that we can pull at different times of the year to make those things happen?
So I would say, I think that's one of the key differentiators, I think, for a CFO and a fractional CFO, and maybe especially a fractional CFO, which is to develop, not necessarily to be a tax expert, but to develop some tax knowledge, to be able to work with the wealth manager, to be able to work with the CPA firm. Now, I have found that, working with 6 or 7 or 8 different CPA firms is very beneficial. Very often there might be 1 or 2 outliers, and it might be going to the owner, CEO of that company and saying, okay, 5 other CPAs are going to do it this way. I think your CPA needs to do it this way. That's my recommendation. But I think that the collaboration between the CPA, the CFO, and the wealth manager from a tax perspective is something very important to each of those professionals, very important from a collaborative perspective, and definitely for a fractional CFO, I think is a real point of difference. And that's what I found in my practice.
Yeah, I think getting those people to collaborate and to really, how do we help each other look good to get to the right result, right? So that it's rare that we're chewing the sausage, making the sausage in front of the clients, right? The 3 groups are getting together to figure out, okay, here's an issue. What are the solutions to the issue? All right, and then presenting that to the client and having he or she make that decision, right?
Right.
So why aren't more business owners served in this way? Why is it relatively novice? I'm told often that not very many people get this kind of attention.
I think it's, there are a couple of things that come to mind. I think the one is there are definitely some owners and or CEOs who are not open to professional advice. I've always shared with clients or potential clients, there are 2 important criteria. You have to be willing to listen to advice, and you have to be willing to pay for it. And I'm not sure either. I think you have to have both. If you have one without the other, I don't think it works well. So I think that's number one. And number 2 is sometimes you find professionals are siloed and not open to collaboration. Mm-hmm. And the collaboration generally, the 1 + 1 is a 3. And so I have occasionally found some CPA firms that want to present themselves rather than necessarily collaborate with the CFO, would rather say, oh, we can do the tax work and we can, give you some CFO kind of advice and direction. And I don't think the CPA firms really have the experience or the bandwidth. And even if they do have the experience, not necessarily the bandwidth, because they have so much else to do. So it doesn't always serve the client well. So having your knowledge, your experience, your skill set, and then collaborating, no question, from what I've seen, gives a better result for the client than those who are tending to operate in their silos and not collaborate. And not all owners or CEOs, I think, see that or get that. And sometimes they have a relationship with a particular professional and are guided by them, and therefore they rely on that guidance and therefore not open to doing something different.
Yeah, you're saying that they're not collaborating. I call it transactional nature, right?
Mm-hmm.
So I think most professionals have a transactional nature, right? If I go get my taxes done, they get that transaction done. I go get my trust done, okay? I get my insurance done. I get my investments. I get, all these different, and then there's coordination gaps,
right?
And if those professionals are so busy doing those transactions, who is going to pick up the laboring oar of coordination and carry the water from professional to professional? Right. A, does the client have the skill set to do it? B, do they have the inclination to do it? Or are they just too busy? And so getting professionals that are willing to be super collaborative and pulling those professionals together, I think gets clients fantastic. I mean, much, much better outcomes.
I agree. I agree fully. I think that using that term of transactional is very relevant. In my mind, whether it's insurance, whether it's estate planning, whether it's taxes, it isn't a one-time event. And I think the discipline and the consistency of doing planning year-round in whatever area is really important. It's the same way whether it's taxes, or even if we look at just producing financials, we don't just do it once a year. We're doing it every month, and we're looking at the numbers every month. And so taxes doesn't necessarily have to be every month, but it should be a number of times during the year, potentially even once a month or a couple times a quarter, to be able to stay on top of it and to be aware of everything that's happening in the tax world, and not just a once a year event when you file your return.
Right. That's kind of too late, right? I mean,
exactly.
What we typically find, Jonny, is it takes between 1 to 3 years to get the project work set up. And then you're on maintenance work. And during that project work phase, you're meeting every 3 weeks to collect all the documents and get the whole plans together, explain it all, put it all in place and whatnot. But then the maintenance piece, you still need to meet. If it isn't monthly, it's every 6 weeks. And having good financials to understand what are the decisions for the next 30 days. It's just necessary. Or people who think, okay, we'll get together in fourth quarter and figure it out. It's just not going to happen.
Right.
Yeah.
Right. That's too late. No question. It's very similar when I think of, Derek, whether it's the wealth management side or tax side, the same applies in CFO, fractional CFO practice. It takes a while to build up to get solid financials. And that first 6 months of that first year is much more difficult. And then you go into a maintenance mode. But you go into the maintenance mode, you don't drop it. You still have the discipline. It's one of the things I think that's a valid principle. I know there's a lot of things that I share in threes, but the financial reporting side, just to share with the folks who are listening, is I always look at it as you define exactly what financial reporting package you want, what's going to provide, what's going to tell the story. It's produced by a certain date, and then the leadership team meets to review that package. So it's applied on a consistent basis. And I think the same applies to tax planning or wealth management, in my mind, in terms of how we've been doing it for this client. It's the same discipline that's applied on a consistent basis.
For sure. And I know if we were interviewing him today, he would give us, I think, very high marks, both you and our group as well, because he's reaping the outcome, right? He's very excited about the results.
100%. Yeah.
So tell me, so we talked about we really need to be collaborative, whether all these disciplines to collaborate to figure out, here's an issue, how do we solve it? How do we solve it together? What are the best ideas? Nobody has all the best ideas. Together we're stronger together. Talk to me about who is the ideal candidate for fractional CFO services. Like, when Should they, all right, I have an accounting team. When do I should have a full-time CFO? Like, who's the ideal candidate between those two chasms?
I would say, generally speaking, any business that is, and I use generally 5 million in revenue plus, the owner or CEO of that business should be considering a fractional CFO. So I've even worked with some companies that are less than 5 million, but it's very difficult to find a way to afford a fractional CFO if you're under about 5 million. And once you're above that number, once you're above 10 million, there's no question there's a role for a fractional CFO. My experience now over a little over 20 years is that companies can go pretty far with a fractional CFO, and that it's far more important to build the accounting team from the bottom up. And whether it's bringing in accounting manager and then bringing in a controller and then eventually a full-time CFO. I've even found with my practice that getting experience with one client over a number of years, even when they've brought in a full-time CFO, that there's still a role for me because now I've built up a tremendous amount of knowledge and experience with that client. And not wanting to be the full-time CFO can be very supportive to a full-time CFO. So it's a very small part of my practice, but it's an underserved, I found it's an underserved area, as most full-time CFOs cannot get through all of their work. They cannot get through all of their projects. And so having somebody that's high level that can take a few of those projects off their plate sometimes can be very valuable and provide really, really high value to a particular company. And that could be in tax planning, it could be in M&A work, it could be insurance, but there are areas that full-time CFO cannot always get to, and having that help can be extremely beneficial. Generally speaking, I think when companies get to about 50 million, they probably should be looking at a full-time CFO. Certainly by 100 million, they should be looking at a full-time CFO. But I think it's very important to hire a strong controller first before bringing in a CFO. One other comment that I would share that I think might be of interest to everybody, and it comes across very often. Often they're controllers that call themselves CFOs. And I think it's important for folks who are listening to understand there is a real difference. Both are very good at what they do. I think, generally speaking, controllers are more focused on the historical numbers, producing financials, backward looking, very good at the details, very good at producing analyses. And the CFOs tend to be more high level, tend to be more forward looking, tend to be more strategic. And a business needs both. My experience is you don't usually find the same skill set. You don't get the same strong skill set in one person. They usually tend to lean one way or the other. And so any business that's 5 or 10 million in revenue should have the controller type of services, and should also have somebody who's more high level and more strategic and helping to look forward, even if it's in a limited role.
Yeah, I think one of the things that you said there, which is just so true, is building it from the bottom up, right? You need those strong people in place to make sure that you're getting really good information, right?
Right. I would say what I've seen over time, and I do less and less detailed work over time as my practice has evolved. But to a large extent, I'm not really able to do my job without having a really good accounting department, which is led by a really good controller or fractional controller. So it's absolutely imperative that the business has their financial story reported and shared every month. Without that, the CFO and the owner CEO are not really able to do what they need to do in order to drive the business.
100%. So if this is you, if you're a business owner and you struggle to get accurate financials and you are really seeking to get income tax advice, like, I think I'm paying too much. I think I'm paying the top rate. Jonny is for hire. He's out there. He's going to, we're going to give you his details if you want to contact him. But getting accurate financials is what's absolutely necessary for the financial people to really help you figure out what is possible for you. If you think you're overpaying your taxes, we're open for business too at Centura Wealth. This is what we do in helping business owners figure out how to set and meet their financial goals. Often mitigating income taxes by 30, 40, 50, 60% or more is often one of those top goals. But this is where it starts. These are the building blocks to make this work. Give us a final thought on what you think business owners should think about as they're thinking about how to do this for themselves.
in terms of looking at a CFO to come in to be able to help them. If there's one of three things that I think are that they're finding, whether you're not getting the financial reporting, you've got cash flow issues, as you just brought up, Derek, you're not getting your taxes done satisfactorily, or you're unsure if you're paying too much or too little in taxes, or usually too much in taxes. My advice to any owner would be to set about to network and to set about and at least interview one or more CFOs, fractional CFOs, and to have them come in and help, if you will, investigate those type of issues, do their due diligence and give you recommendations. And similarly, as you mentioned, anybody who's unsure whether they're meeting their financial or wealth goals, they should be reaching out to you and should be going through that same kind of due diligence process and have a look at what they've got in place and take the necessary corrective action.
Awesome. Jonny, how would our listening audience contact you? What was the best way to reach you?
Best way is probably email. It's jborok@jngcfo.com. It's jborok @Jen and Nancy Glenn Charlie Frank Oscar.com. Or feel free to call me or text me, 858-336-5907. That's my cell phone.
Jonny, thank you so much for being on the show today. I'm your host, Derek Myron, and if you need to reach us, we're here at the Live Life Liberated podcast, and we want to thank you for listening today. RJ, take us out.
Thank you, Derek, and most importantly, thank you for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you've not subscribed to the podcast, please click the subscribe button below. This way, when the team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Centura Wealth Advisory, I'm RJ Malik, reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.